The next assignment is, and this is very, very common, it's an assignment, again, at non-arm's length, where we assign a policy to a child. So this happens quite often, where parents buy an insurance policy to say on their children, and then when they are of age majority, whatever it is, they transfer the policy over at some future date and everything else, okay? Sometimes even grandparents buy it on their grandchildren, for example. They want to leave a legacy, they want to leave a certain amount of money there for educational purposes, buying a house, whatever. In other words, grandma and grandpa, they would like to be able to leave some money to that child, and the money should be received, like I said, when they reach age of majority. So the transferring of a policy for children is quite common. Okay? So basically, the parents or the grandparents own the policy while that child is a minor age and everything else. Okay, but at some point, the policy, of course, will be transferred over when the child becomes an adult. Okay, so what we've got here is Mary owns a policy on Sarah. And Mary is the mother in this particular case, and Sarah is the daughter in this case. Okay, and she owns a policy on. So Mary owns a policy on her daughter. And at the time of transfer, the time the money is actually transferred, the policy is actually transferred, the adjusted cost base is $16,000. So there's your ACB. The cash surrender value is $29,500. Okay. Now, once again, because it is a non-arm's length transaction, once again, the proceeds of this position will be the same, $16,000. In other words, the ACB, Mary's ACB, will now be acquired by Sarah as the same ACB. So in other words, the proceeds are still going to be $16,000 in that there is no actual deemed disposition. And so therefore, Sarah acquires this policy now at an ACB of $16,000. So far, so good, okay? Now, at age 25, Sarah decides that she's going to cash the policy in or borrow the money, whatever it is. In other words, she needs the money for university, whatever the case may be. And at that time, there's $40,000 of actual cash sitting in that policy. So now, because she is an adult and everything else, she owns that contract and everything else. That policy gain, of course, will be the difference between what she acquired it at, which in this case was $16,000, and of course the money that is in the policy at that time. So therefore, the difference between these two is $24,000. That $24,000 then, according to Sarah's MTR. Now, theoretically, Sarah's marginal tax rate will be quite low at that particular age. And so therefore, there could be a considerable amount of tax savings by doing this. But the good news, like I said, is that when you're doing intergenerational transfer, and that's what this non-arm's length is really all about, you're transferring a policy to your spouse, to your children, to your grandchildren, great-grandchildren, things of that nature there. These are all what we call non-arm's length transactions. And so therefore, the bottom line is that your ACB, or whatever your ACB happens to be at the time you transfer it, to the transferee, basically that ACB will be the exact same ACB. So therefore, there is no actual disposition at that point. But when that child reaches the age of majority, then you transfer that policy. Then the policy now is owned by that child, and they can keep the policy going for as long as they want. However, when they in fact do cash that policy in, the difference between the ACB that you transferred at the time you transferred, for example, $16,000, and the proceeds of this position, which in this case is the $40,000, that difference will be considered a policy gain. And once again, taxes will have to be paid. But this time, the taxes will be paid by the child. So in other words, there's no attribution at this point. Unlike with the spouse, there could be attribution. With the children, well, as long as the children are over age 18, let's say beyond the age of majority, there is no attribution, and there's, as a result, the tax rate will be according to Sarah's tax rate. Now, something to remember is that if by chance the policy was in fact cashed out, transferred over to that child while they were minors, and then the policy was actually canceled before they reach age 18, then the attribution will be back to Mary again. In other words, up to age 18, if there's any kind of cancellation whatsoever, Mary will be responsible for paying the taxes. Okay, but once that child reaches age 18, the policy transferred over, then Mary's off the hook. Basically, now the new responsibility lies with with that child, and that's the big advantage in that you're transferring money from maybe a high tax earner and high MTR to a child which obviously would be a lower MTR. So there could be considerable amount of tax saving from that perspective. Okay. The other thing to note is that in some cases what happens is people will, parents, grandparents, whatever, will transfer the policy not directly to the child, but they're concerned about controlling that policy and everything, so they transfer a policy over to a trust on behalf of that child. So in other words, a trust is set up on behalf of that child and everything else. And so the policy is actually transferred to the trust. When you transfer the policy to the trust, then there is a deemed disposition. In other words, there is no rollover provision. This is all rollover, okay, all rollover. But the moment you transfer policy to a trust, even though the beneficiary of that trust is the child, the trust is basically a legal entity unto itself. And so therefore, there is no rollover provision. So in that case, then there will be a deemed disposition, and you will have to pay the tax at the time of transfer from yourself, let's say, to a trust. And that doesn't matter whether the child is young or whether the child is of age. It doesn't really matter. The moment you move it over to a trust as a legal entity, then you basically have sold it, you might say, to a trust, and therefore there will be a deemed disposition at that point. But as long as you don't do that, and as long as you transfer that policy over to the child when that child is 18 or older, then there is a rollover provision, which again, there will be no deemed disposition until the child actually cancels the policy themselves. Now, once again, the parents could say, well, we want to opt out of the rollover provision. We'd rather pay the taxes now ourselves. So that way the future gain is the only thing that Sarah won't have to worry about. That's perfectly fine. There's nothing wrong with that, because in that case, then it will be $40,000 would be the ACB. So the parents, let's say, pay the tax on Mary, would pay the tax for this amount here, let's say, right now, but the new ACB then will be $40,000. So therefore, Sarah only has to worry about the gain between the new ACB, which is $40,000, and whatever the proceeds are at that point. So that really is, it's very much up to how you structure this thing here. The point we're getting at is that if you have a rollover, you're allowed to sponsor rollover, you're allowed rollover for children, no deemed disposition. That does not necessarily mean, however, that you can't opt out. If you wish to pay the tax up front, that's perfectly fine. You pay your taxes. In this case here, the gain, like I said, between $16,000 and $29,500, that would be the gain. Then that's perfectly fine. You pay your tax accordingly. And then from that point on, the new ACB kicks in, and that'll be the responsibility of that child. So essentially what we're saying here in terms of assigning a policy on an absolute basis, if it's an arm's length type of situation, then you do have a deemed disposition. Whether you do it while you're alive or whether you do it while you're dead, there is definitely a deemed disposition. In a non-arm's length transaction where you're transferring to a spouse, children, grandchildren, great-grandchildren, then there is no deemed disposition. So basically, who you're transferring to will step into your shoes, you might say, therefore there'll be no disposition at that point. But when the policy is actually canceled at a future date, and of course there will be taxation that to be paid between the old ACB, you might say, and the new cash value that's in that policy. And in some cases, attribution rules will apply, so we need to take a look at that. But again, attribution rules are very complex, so it's well beyond the scope of this particular lesson.